Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will dive deep into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new longer episodes every Tuesday and our shorter ones every Friday.
Hello and welcome to this week's episode of the Prime Property Finance Podcast. My name is Mark, and in today's episode I just want to explore the question as to how important are interest rates in buy-to-let investing really. So it's a really hot topic at the moment, has been for some time, especially with what's going on in the world. Interest rates are quite volatile, they're changing all the time. Unfortunately for many, they've been going in the wrong direction, i.e. up. But I just wanted to explore the interest rates. Some people treat it like it's a life or death situation, which I get and I fully respect. However, I just want to explain in what it's like in reality and whether that the interest rate is as important as is perhaps perceived. So that's what we're going to cover in this episode. Just a bit of a musing on my part, really, around some of my thoughts, having run some of the numbers, and also to explore what other parts really can actually make or break a deal as well. So, interest rates, do they matter? Well, yes, it goes without saying, absolutely they do matter. Invariably, the biggest cost to your buy-to-let portfolio is going to be your mortgage costs. Okay, so absolutely you should have a razor-sharp eye on your interest rates. However, is that the be-all and end-all of the portfolio if your portfolio moves by 0.5% or 0.75% or down 1% or what have you? Okay, yes, it changes margins, but does it fundamentally break the portfolio? That's a question that is up for debate, I guess, and it depends on your personal set of circumstances. But I just wanted to explore the other elements that could probably have bigger impact than just an interest rate alone. Okay, so as we know, cash flow is king, or cash is king, cash flow is king. So whilst we all want the best interest rates on our buy-to-let deals, there's other things or other levers we can pull that can take away from the impact of potential increases in interest rates. So, for example, the income that you're receiving, i.e. the rent, has that been reviewed and is that up to date? Now, there is a balance here around good tenants, keeping and looking after them. There's also a commercial decision to be made around the longevity of your portfolio and the sustainability of your portfolio on if you don't review the rents frequently enough. Okay, so whilst your interest rate may go up 0.5%, if you haven't reviewed your income in terms of rental income, that may be going up 3, 4, 5%, okay, which negates the uplift in interest that you may have. Okay, other areas that are really key to the portfolio are going to be tenant quality, which I just touched upon. Okay, so tenants that don't pay on time, are late, running arrears, don't look after the property, you have particularly high maintenance issues with them because they're not looked after and so on. That can cost significantly more than an interest rate change of 0.5% per annum can. And please note that when I say 0.5%, I mean 0.5% per year. Okay. Now I understand the compounded impact of that if it continually keeps going up. However, it's 0.5% per year and it's relative to the loan size and what you're getting in income. Okay, but I'm just trying to put a bit of perspective into the interest rate changes that we're currently experiencing. Area quality, so we're looking at voids here. If there's a high turnover of people on the property, then you've got your costs of finding new tenants, keeping them, as I say, you want to keep them as long as you possibly can, tenant quality. So we're looking at void periods. There is a cost to that turnover of it. I've already mentioned maintenance, okay, having good quality maintenance, good quality products, I guess, in the property. I understand the idea of, just not spending too much on a property. Again, there's a balance between quality and longevity of things in a property as well. So there's that to bear in mind. Asset quality. So we know that property, as a general rule, will increase in value over time. Okay, there are pockets obviously where that doesn't necessarily play out, but we know that it will invariably increase over time, 10, 15 years. Okay, if you keep the quality of your asset high, then the appreciation of it is likely to be higher. And will that growth, if you consider inflation runs at 2 to 3%, when it should be in line with government expectations, we would expect to see that in property as well. So 2 to 3% increases per annum, but you've got a 0.5% increase in interest rates. So again, just trying to put it into context of the overall picture when it comes to buy-to-let investing. And as I say, there's this long-term demand for the property itself. Okay, so as an example, if we take a £150,000 loan, which is said to be the average loan in the buy-to-let space, and we take an interest rate of 5%, okay, on an interest-only basis, because the math is easy to work out on my part, is on 5% on £150,000 equates to £7,500 a year in interest payments. Okay, on a monthly basis, that equates to £625 a month. Now, if we took the interest rate up by 0.5% to 5.5%, that takes us to £8,250 a year, and will have the impact of increasing the mortgage to £687.50. Okay, so as you can see, there's a price difference there of £62.50. Now, I come back to in the grand scheme of your investment over the longer term, when you consider capital appreciation, when you consider the rents, and you can increase the rents on an annual basis in line with whatever you deem to be sensible, then you can see that the £62.50, whilst it will squeeze your margin in the immediate term, okay, actually over time, the increase is not that bad, okay? It's certainly not going to break your deal. And if an increase of 0.5% is going to mean that you can no longer afford your mortgage payments, then it's probably not the interest rates that's the issue here, okay? It's probably something else that's fundamentally wrong. You're probably not charging enough rent on it, or you paid too much for the property in the first instance. There's a saying in property that you make your money when you buy, okay? And that is a prime example when that happens, okay? So nobody wants higher interest rates, absolutely not, okay? However, it is a fact of life, unfortunately, and it's something that we have to navigate, and we have to navigate as best as we can. Sitting on your standard variable rate, possibly 7, maybe 8%, waiting for the interest rate to go down 0.5%, okay? So let's just run the numbers on that actually, is let's say the SVR, the standard variable rate is 8%, okay? And you are waiting for interest rates to go back down because of the conflict, because you think 5.5% is too high, okay? And let's say you're waiting for it to go down to more like 4.5%. So that is a 1% decrease from where we're currently at. Now that might take some time actually, because interest rates tend to go a 0.25% drops, okay, is you're going to be sitting on a rate that's 2.5% higher than it needs to be for at least a year. Now, let's say that you manage to get your 4.5% in 1 year's time. You've got 2.5% to make up, and it will take you 2.5 years to break even on that interest rate. Just by delaying it for 1 year, it'll take you 2.5 years to get that money back. Whereas you could have locked yourself in at the 5.5% and you wouldn't have had that pain in the short term. Plus, notwithstanding, the SVR at 8% is going to represent a significantly higher increase in mortgage payments for that period, which is going to make a big impact on your cash flow. Okay, so the reason for the episode is not to say that interest rates are not important. They absolutely are. As I say, they're one of the biggest expenses that will exist in your portfolio, in your buy-to-let portfolio. However, with these interest rates, and we see a lot of people sitting on them waiting for rates to do what they think they're going to do, and invariably they don't do what you think you're going to do. You know, the world is a volatile place at the moment. We all thought we were going to have 12 months of stability at least this year, and then the war started and has pushed the markets into a bit of turmoil again. So there's no telling what's going to happen in the future. You can just look at what the current position is today and then make a decision based on that information. The reason for the episode is to demonstrate to you that a 0.5% increase in interest rates shouldn't necessarily be catastrophic to your portfolio. There's other levers that you can pull in order to navigate through that and to mitigate that impact on your portfolio. Okay, and also there are other things at play here which I've just mentioned, such as maintenance, voids, tenant quality, capital appreciation. All of this falls into the equation when we're looking at the viability and the sustainability of a property. So hopefully that makes a bit of sense to you. Hopefully that makes a point really that interest rates are important, but not the be all and end all. And that, yes, we all want the cheapest borrowing out there and available, but if it's not available, there are other things that we need to be paying attention to as well. So please, with that in mind, just bear that idea and thought process when you're assessing the viability of your portfolio. If you have any questions or concerns, we have this conversation a lot around the best rates, what it means to your portfolio, the impact, the stress testing, and so on. We do have a piece of software called pintech.io. Check it out. This is what this software is designed for, to help you with the day-to-day, but also to help you with the financial analysis, understand the impact of interest rates on your portfolio so that you can be ahead of the curve. You can make decisions before it happens, get in line so that these impacts are less when they do happen in the future. So hope you found that useful. Slightly different way of thinking about things, hopefully. And if you have any questions, as I say, just do please let us know. And thank you very much for listening.
Thank you so much for listening to our podcast. We hope you have learned something and have some tips to take away. We'd be very grateful if you enjoyed the show. You could give us a review and share with anyone that you know that may be interested. And of course, subscribe to the show so you can get notified when a new episode is released. If you'd like us to answer any questions or go deeper on a specific topic, please drop us a message at primeproperty.finance. See you on the next episode.